Ready?
Yes.
Welcome everyone to our YouTube live, and we'll be together for an hour, and it's the usual procedure where if you're one of our YouTube supporters, you'll be pushed to the front of the queue. We'll answer your questions first, and you can also ask using a super chat, and then again, you'll be pushed to the front of the queue and we'll answer your question first, just because these are the people that support us, so we will favor those people. Right, so this week, I think it's kind of interesting to just kind of start off talking about what's going on in markets. We have seen yields pick up quite substantially. So in the US, we've seen yields increase across the curve. And some people say that's because people are expecting higher inflation. Some people say it's because the Fed has said that it's going to raise interest rates, or at least it's going to start tapering at the November the 2nd and 3rd meeting of the FOMC. So it's pretty much a dead cert, never completely certain, but it's almost a dead cert that they are going to announce the first step in the tapering. Remember, tapering is when they reduce the rate of asset purchases. So instead of $80 billion worth of treasuries a month and $40 billion worth of mortgage-backed securities, they'll dial back the rate of asset purchases and they'll gradually slide it down to zero over the course of about 6 months to a year. So, they've kind of messaged that that's going to happen very, very clearly. And remember that the threshold for that is much lower than the threshold for raising interest rates. And that probably will happen several months, if not, maybe even a year after the end of tapering, or certainly after the beginning of tapering. So rate hikes, not for a while, but already the equity market has been rattled by the fact that interest rates have increased. And yet again, we've seen very expensive tech stocks sell off. So the NASDAQ was particularly hard hit. Although there has been inflow into QQQ, for example, which is the NASDAQ tracker, and the leveraged form of QQQ, which is TQQQ, unpronounceable. But that shows that people are still willing to buy the dip. So although we have seen the S&P fall from its highs at the beginning of September, and this is looking like the worst month in terms of falls for the S&P for a long time, that still shows that people are willing to buy the dips. And if people are willing to buy the dips, then we won't get very long dips. Now, when things really change is when the narrative changes and when people capitulate. And we're a long way from capitulation, where people say, okay, I'm just not interested in equity anymore. I don't think it's worthwhile investing in equity, and I just don't want to touch equity ever again in my life. We're miles away from that at the moment. So we still have the situation where we get these short dips, a very quick rally, and if you sell when one of the dips happens, you'll be locked out of the market. So I know that the community messages, I can see it in the community messages, with all the talk of a taper tantrum and also a default on US treasuries, a lot of people are getting quite nervous. But the trick is, don't sell. Don't sell if equity markets fall, because it's very likely you'll be locked out of a rising market. So that's a kind of overview of where we are right now. And in terms of inflation, I think it's fair to say that the narrative does seem to be shifting slightly to more people saying that we could get wage spirals. So wages chase prices and prices chase wages. That's looking more likely, but personally I think that's still quite a long way off, because we haven't seen very large wage inflation yet, particularly in the US. In the UK, different story, because we have a much more restricted pool of labour now, and higher wages for a large part of the service sector looks quite likely because of the restriction of the labour pool. But, we all saw that coming, I guess, for the UK. So let's get on to the questions. And there's an interesting one about Kevin, who says, you talked... Oh, and one from Thomas Crew. Hi, Thomas. Thomas is one of our YouTube supporters. He says, greetings from soggy Mississippi, where the forecast is for more rain and higher bond yields. Very good. I like that. The waters are rising. Yeah. So Kevin, you talked last week about a great future for genetic RNA innovation. What are your views about investing in the ArcG genomic revolution as a long-term investment? Yeah, I mean, you can invest in ArcG. Interesting anecdote. Obviously, I speak to a lot of very smart people during a power hour. Now, a power hour is like a one-to-one coaching session with me. And one of the people that I spoke to was worked for many years in the biotech industry in America, in California, I believe. And when he looked at the ArcG fund, he was just shocked at the names it contained, because a lot of the companies he thought weren't very good quality. And certainly he didn't think they justified a place in the fund. So that was an eye-opener to me. I mean, I'm certainly no domain expert with those biotech sector companies, but the only relationship I've got with this kind of technology was because for my PhD, I did a little bit of molecular biology, a bit of gene splicing, a few restriction enzymes, ran a few gels, cut my finger on a radioactive gel. Because we used to have to use these radioactive gels to actually visualize the sequence once you were sequencing a piece of DNA. So anyway, I cut my finger on one of those gels. Wasn't pleasant. So yeah, I mean, I've got familiarity with the technology, but I'd be worried that I think the problem with Cathie Wood's investment style is she really doesn't care about profitability. And I think one of the problems is that will identify good growth companies, but there's also a risk that it buys some duds, and several duds in this case. So that's my concern with Cathie. She buys at any price, and if you just got to look at the returns of all of her funds to see that they are underperforming quite severely over the last 6 months after the huge run-up that we had previously. But, you know, I made a video about that, and it was completely expected that would happen. So, you know, I mean, if you are going to buy ArcG, what I'd probably do is wait until there's an equity market correction, until you do that and valuations look more reasonable, because there you might find some upside. But I think given where prices are now, I still think we haven't seen much of a correction. So I think she's probably still overpaying for those stocks. But look, you can still buy the individual stocks like Moderna, or look at the allocation for ArcG and some other biotech funds and just see which ones they talk about. What's great about Cathie Wood's operation is she's completely transparent. She talks about the investment thesis for all of the stocks that she buys. And I laud her for that. I think that's incredible. And I think it's a great way for people to learn. Just read her reports. You may not agree with everything. It's probably good if you don't agree with everything, but you will learn a lot. And the same thing for Scottish Mortgage Investment Trust in the UK. It's not anything to do with mortgages. It's like ARC, but that also invests in companies like Moderna. In fact, I think it does have an allocation to Moderna. So similarly, you know, you can look at those reports and just build your own portfolio, which just chooses the stocks that you like with that theme. And that might be a better way to do it. But yeah, as usual, you know, with single stocks, don't put too much into an individual stock. You know, more than 5% in any one stock is probably a bad idea because the concentration risk will be too high. So this should be just a kind of satellite investment for you. Okay, next question.
Messages for you.
Oh, messages. Right. Please do like our stream because it helps us. Even if you're watching in playback, like it. And obviously the algorithm likes that if you like it. And share this with your friends because other people may find this helpful. And so yes, Stephen J, thank you for your question, who is one of our supporters. Thank you, Stephen. He says, off the top of your head, is there a trust fund alternative to FTSE All World rather than the ETFs? what are the trust fund alternatives would you know that would be alternatives? S&P 500. Thanks. I guess by trust you mean investment trust. So if you do want to know, the problem with investment trusts is that they're usually active, and that means expensive, and that also means often underperforming. So that's why I'd be a little bit cautious about going for global equity exposure via a trust fund. But any global equity fund which you buy via an investment trust would satisfy that criterion. So I'm trying to think of one. There's one from, just trying to think if, yeah, let me have a quick look at, yeah. So this one is a popular one in the UK. So, so this is the alternate. So the two funds that everyone talks about when I speak to UK investors, one of them is Fundsmith. Now, Fundsmith is just a normal fund. I don't think it's an investment trust. But the other one, which is an investment trust, obviously Scottish Mortgage is an investment trust, and that is a global fund, but it's very growth oriented. And the other one is Lindsell Train. So let's have a look at Lindsell Train. And I'll show you on SharePad just so that you can see what it looks like, and we can go through some of the fundamentals for the fund. So let me share my screen. Okay, so I should be appearing in the bottom left, and here is a list of funds from Lindsell Train. So Lindsell Train Investment Trust, that's the company itself, and Lindsell Train Global Equity is this one. So let's have a look to see which one is the primary share class. So it looks like the primary share class is this one. I think it's the B class. So let's switch to that instrument. And you can see the ongoing charge for that is pretty high, 0.65. And the yield is pretty low, so you're getting 1% dividend yield. And in terms of the rank in the sector, you can see that it's not ranked very highly compared to other funds in the sector at the moment. Another way to look at to see whether an investment trust is popular or not is look at the price relative to the net asset value. And for this one, it looks pretty, the price to NAV looks pretty high. So it looks like it's still popular. So if we do a chart, you can actually plot the NAV, the net asset value, alongside the price. Now, when the price is above the net asset value, that means that it's very popular and it's kind of trading at a premium. And in this case, I can't see what the NAV is, unfortunately. Nope, it's not plotting. But that's another thing to consider when you buy one of these investment trusts, which is it trading at a discount or a premium? And if it's trading at a discount, then that might be a bargain, because other people are not buying the fund, so it's not seeming so popular. But this one might be one to consider. It's global. It does have a slight tilt to Japan. It's also got a very interesting country composition. So if you look at the portfolio and break it down by countries, the UK is heavily overweight in it, so 35%. The US is underweight, hugely underweight, only 30%. Remember, market cap weighting would be more like 55% US or 60%. And a big Japan overweight as well, because they have a lot of expertise in Japanese stocks. So it is a fairly odd country allocation. And they do tend to go for very old and established brands. So, for example, Diageo, Heineken, Walt Disney, Pepsi. And they are very fundamentally driven. So, yeah, maybe that's one to consider. That's quite popular with the other pension crafters. When I speak to them, that's what they say. So maybe that's one to consider. But the problem, as you can see, is that these investment trusts, because they're active, are very expensive. So just bear that in mind. Right, so back to me. Oh, another member's question. Thank you, Laura. Gary, thank you for supporting us. Gary Cunningham. Hi, do you have any thoughts on Vanguard ESG Developed World All Cap Equity Index Fund? Oh, and he's given me an ISIN code so I can look it up. Very good. So this is an ESG version of a global equity fund. So let's have a look at that one. And I hope by kind of going through how I read these fund descriptions, I'm showing you how to do it for yourself. Let me just share this again. Yeah, so this is the summary of the fund on SharePad. And you can see that the ongoing charge here is much lower, so 0.2%. So immediately you know this is going to be a passive fund. And it's an open-ended investment company, so it's a mutual fund, not an ETF. Now on some platforms that means it's more expensive to hold, for example Hargreaves Lansdown in the UK. It's an accumulation fund, so the dividend is accumulated, so you're not having to reinvest those dribs and drabs of cash which come from an income fund. So it's all reinvested back into the fund. The yield is 1%. It is a global fund, so it will be market cap weighted because it's passive. So let's have a look at the portfolio and look at the countries. And yeah, you can see this is a market cap weighting. 67% US, 7% Japan, and only 4% UK. So that's a market cap weighting that's strongly dominated by the US. And because it's ESG, it probably doesn't have any energy in it. Yeah, so you can see there's no energy, and it usually has a little bit of a software tilt and an internet type of tilt. So you can see software, internet, consumer electronics, all of those are the top three sectors by weight. What do I think of it? Well, yeah, I guess the forecast PE isn't particularly high, so that's attractive. Only 20 times forward PE. Fairly good forecast growth, 16%. Historical earnings growth, not so great, 1.9%. That's a developed market rate of earnings growth. And then if I look at the actual performance of the fund, you'll notice I look at that last. It is just a global equity tracker. So if we plotted that versus almost any other global equity tracker, we'll see that that's actually kind of similar. So let's look at another global equity one. So let's look at MSCI World, for example. And yeah, that'll do. So if we plot it versus MSCI World, you can see the returns are very similar indeed. And no surprises there, right? So the ESG aspect of it makes very little difference to the return, because what they'll do is they'll take a parent index, they'll cross off the companies which don't meet the ESG criteria, and that's how you'll end up with this fund. Now, do I believe that ESG is a good idea? Probably not, because I don't agree with everyone else's definition of what's ethically acceptable. My views will be different from other people. For example, I'm a physicist. I've done some molecular biology in the past, so I've got no issues with companies that do create genetically modified crops or which produce nuclear power. But other people feel very strongly that those two things shouldn't be allowed. So I think, different people's ethics vary. Just make sure that your ethics are in line with the ESG version of the fund that you're looking at. And sometimes there are some real surprises in there. So for example, energy companies in an ESG index, sometimes there is an energy weighting. And so you'll probably be thinking, how did that get there? Because the ESG scores are self-reported by the companies. So you have to rely on the companies to report accurately rather than just tick boxes willy-nilly. There will be a certain level of oversight from the fund manager, but I'm sure that some slip through without being properly ESG. Right. Back to the questions. So do like our stream, and even if you're watching in replay, and Teddy's grumbling. Is it because he hasn't had his treat? I think it is actually. Let me just get a treat for Teddy, because he was just growling. That wasn't my tummy, if you were wondering. So there we go. Hey Ted, treat, come on. Oh yes, good boy. Brilliant. Okay, so back to the questions. Nice question. Oh, another supporter question. Thank you, Laura, from OHNMSP. I can't pronounce that.
J starts with a J. I cut it off.
Oh, John MSP. Sorry. John MSP. Suggestions for the last 15 years of life investing strategy. Oh, okay. So, yeah, I think this is an interesting question, because I think what many people assume is that as you get older, you should reduce your risk. Now, it turns out that for many people I speak to, they have sufficient income from other sources. So let's say you've got a buy-to-let property, or you've got a defined benefit pension, which is paying you as if it was a bond. Well, the income from the property is also like a bond. You know, you'll get that rental income year after year, and you'll get the defined benefit income year after year, and you're not taking any market risk with a defined benefit pension. If that's the case, then your risk capacity, your ability to take risk, is much greater. Because if you've got the safe income which meets your needs, then any extra income from your investments is completely optional. You know, you don't really need it in order to make ends meet. So often what you find is that people's risk capacity increases as they get older, as their requirements, their expenditure actually isn't that high, and they've got an income which they're quite happy with enough set aside for some treats, you know, holidays together, or whatever it is that they want to do. So it really depends on whether your capacity is fairly high, but also your risk appetite, because some people are just cautious by nature. I am. And if that's the case, then you may not be comfortable taking a lot of risk. But my point is that for many people, the optimal drawdown strategy is to start off with a bond equity mix, whatever, 60-40 or whatever it is you start with on the day of retirement, because your sequencing risk, your biggest risk, is when you have the largest amount of money. Because if you have a crystallized loss on that starting point, then that'll compound over time and have a huge impact on when your money runs out. Whereas if you have a crash towards the end of that period, you know, when you're reaching the end of your life, there'll be less money in the pot, and the impact on when the money runs out is much smaller. So that maximum sensitivity is when you've got the largest amount in the pot. So that's when you have to be most cautious. So what you do after that is actually you increase the risk of your portfolio by selling the treasuries and the bonds first, exhaust the treasuries, and then start selling the equity. Now, I know this seems counterintuitive, but I did a video on portfolio rebalancing. If you look on YouTube, just look for PensionCraft. I think it was maximizing returns by rebalancing. Not a great name, but if you look at that video, you'll see that that's how it actually turns out, that if you do the back tests, for many people, that's the optimal way of drawing down on your pension savings. So that's kind of surprising, I think. But look, if you're the kind of person who's not comfortable taking risk, then you'll keep that bond allocation for the rest of your life. And you may want to de-risk as time goes by and just keep a low-risk portfolio. It's just that historically you can show that that's given you lower returns than if you just held equity and just sold your bonds first and kept your equity as long as possible, so it compounds as much as possible. And the reason why this works is because equity gives you higher return than bonds, almost always. And if that's the case, then you want to hold your bonds for as long as possible so they can compound as much as possible, and then sell the government bonds first. So I hope that answers your question, John MSP. Oh, and there's another question from Arsenio Cornelio Penesi, who has a very cool name. He says, hi, Ramin, Laura and Teddy. That's you. Yeah. And Laura. Yeah. He says, what's your opinion on COCOs for retail investors? In which macroeconomic environment do they perform well? And is the Wisdom Tree AT1 COCO bond UCITS ETF a suitable instrument to gain exposure to this type of asset? Yeah, I mean, COCOs are interesting because it's very much like the English spread called Marmite. If you're not familiar with it, in England we have this kind of spread you put on toast called Marmite. It's made from yeast byproducts. I love it. Some people absolutely hate it. But COCOs are exactly the same. Nobody feels indifferent about them. They're either the spawn of Satan or they're the best thing ever. Let me just tell you how they work. So, as you know, when a company has a capital structure, if a company goes into liquidation, then the people at the top of the capital structure, usually the senior bondholders, or sometimes they set aside a pool of assets which go with bonds so that you'll always be made whole. So those will be senior secured bonds. And in that case, you'll almost get 100% of your capital back because you'll be paid first. Then you get the kind of senior unsecured bonds, which don't have any pools of assets set aside to pay off their creditors. And those will be paid next. Usually you'll get a high recovery rate, 40% for those. And then as you go down the capital structure, you get to junior unsecured bonds, which will get even a lower recovery rate. Then you get into the hybrid instruments, and then you get into the equity, which gets a 0% recovery. Now, COCOs are kind of interesting. They're called contingent bonds, contingent on. Let's have a look, actually. Let's look at one of these COCO funds, actually, because that's interesting. Alternative Tier 1 capital is the definition. And let me see if I can find an example of one of these funds. I think, did you mention one? Wisdom Tree, 81 COCOs. So the idea with these things is that you get this trigger. When does the trigger happen? Well, it's when bad things happen to the company. So for banks, when their tier 1 capital falls below a certain threshold, then these COCOs kick in and automatically raise capital for the bank. So that's why, it's great for the bank because, they issue these COCO bonds, and then in the event of their regulatory capital falling below a critical amount, then these things automatically kick in and they don't have to go to the government for a handout. So it's good from the point of view of the regulator, and they count towards the solvency of the bank. So they make the bank look good because it seems like it's prepared for bad things happening. But obviously, if you buy one of these things, you've got a bond that pays you a high coupon until the bank runs into trouble, in which case you're given some equity in the company. So your bonds convert into equity. But remember that the recovery rate on the equity is very low. It's 0. So if the bank does then become bankrupt, then you'll lose all of your equity investment. So that's why maybe it's not such a good thing if you think there is about to be a huge shake-up in the finance industry. But let's look at the Wisdom Tree 81 fund. I think you'll see it's amazing, the returns that we've had recently. 81. Yes, here it is. Let me share my screen with you so you can see this. And okay. Right, so this is a Wisdom Tree 81 COCO bond fund. So the fee for this, 0.39%. It's dollar denominated. And there's a sterling hedged version if you want that kind of thing. And the ongoing charges for that one is 0.39. And if we look at the return on it, so let's have a look at the chart. you can see that the blue line here is MSCI World, right? So MSCI World's gone up like crazy. The AT1 bond fund hasn't. And so you've got less participation on the upside. And so it hasn't been that great. But what this doesn't show you, I don't think, is the accumulation. Oh, this is an accumulation version, so that'll be better to show you. So once we add the actual accumulated income, which is then reinvested, it looks a lot better. So if I switch between those two, you can see the huge effect of the income on the return of these funds. And the reason for that is that the dividend yield is very high. So if we look at the coupon, you'll see that it's about 5.2%. So immediately you can see what kind of environment these would be good. So banks are cyclical, and if banks are going to be doing very well, you're probably off just buying the bank stocks. If you're not so sure that the banks are going to do really well, if you think your markets are just going to kind of bob along sideways, then why not milk the banks for a high income and buy one of these cocoa funds? Because you can see the return from the income is very high. So the capital gain would be greater in the equity side of banks. The income would be greater from the cocoa side. So if you think huge cyclical upside, you know, the global economy is going to be on fire, banks are going to be printing money left, right, center. I'm not talking about monetary policy. I'm just talking about making lots of profits. In that case, you'd go for the equity. But if you think things are going to be kind of okay, but not a disaster, then the cocos might be a better way to get financial exposure. And let's just quickly look at the sector composition just to make sure that it is financials. Yeah, UK, it makes up 29% of the fund. So a lot of cocos issued in the UK. Switzerland 15%, France 11%, Netherlands 8%. So it's mostly European. It's all European. And if we look at the asset allocation, yeah, well, obviously it's all convertibles. And if we look at the banks whose bonds it holds, you can see this is all financials. So no surprises, it's financials that use this means of raising capital. So I hope that answers your question. Cocos are kind of something which goes around in cycles. I remember at one point I went to visit a client when I was an investment banking strategist, and their fund had to turn clients away because their cocoa funds were so popular that they just had to say, look, we can't take any more money. We've run out of bonds to buy. So it does go in cycles when cocos are very popular. And as I say, I think usually that'll happen when people are desperate for income, when interest rates are fairly low, which was the case over the last 5-7 years. And people wanted a good capital gain, and they didn't expect a crisis in the banking sector. So that combination of macroeconomic backdrop, that's the kind of environment where I'd buy a cocoa fund. So I hope that helps answer your question.
Super chat.
Arsenio, back to me. Yeah, so do like our stream because obviously it helps us and the algorithm likes it. And do subscribe to our channel as well because you'll see our new videos. I work really hard to try and make the videos very interesting. So does Laura and Teddy as well. And, you know, people do find them helpful. So why not sign up? Then you won't miss one. So back to the chats. Oh, it was the super chat from Hedge Fund. Good name. So super chat has, so Hedge Fund has given us £5. Thank you very much. He says, I understand that your Vanguard portfolio includes both UK long-term UK gilts and hedged US Treasury bonds. That's right. Will you still invest in these? Interesting question, because there was actually a question on Slack today on our PensionCraft Slack channel, which you get access to as a Patreon supporter. So if you're in the inner circle of PensionCraft, that's what you get access to. And somebody was saying, would you buy more bonds now that they've fallen in price? Now, personally, I would consider that because, for example, at the beginning of the year, what we saw, everyone was convinced we were going to get really high inflation. And we saw bond yields rise very sharply, and we saw bond prices fall very sharply. And I made a big loss, 10-12% on my long duration gilts. But I didn't sell them. I did consider buying more, but I didn't. Perhaps I should have. But I think just as with equity, whenever you see equity markets fall, you buy more. With bonds, you could do the same thing. But nobody ever says that. They never say, oh, if bonds are falling, you'd buy more. Which is an interesting dichotomy between the two asset classes. But if you are contrarian, then maybe your view is that people think that rates are going to be raised much more quickly than people think, that they'll be raised to a higher level than people think, in which case, if you do think that rates are going to go really high, really fast, then you wouldn't buy bonds. But if you think other people have overblown that point of view, and that actually they won't be raised that fast because the economic recovery won't be so strong as people think, and inflation won't be as long-lasting as people think, then if you're contrarian, yeah, you'd go out and you'd buy bonds, and you'd buy long duration. Why haven't I sold mine? Well, I still believe, and I'm very much convinced that if there was a very sharp equity market fall, then they would hedge my equity. Now, there is one example where that wouldn't be true. Actually, a couple of examples, which I did a video about this week, actually. A taper tantrum is when markets get spooked that the Federal Reserve will stop buying treasuries. So treasury prices fall, and at the same time, usually growth stocks fall. And because growth stocks are such a large part of global indices, Apple, Google, Microsoft make up such a large proportion of global equity indices, those are very sensitive to interest rates. So those fall too. So equity and bonds fall at the same time. And so in a taper tantrum reaction, which is pretty much what we've seen over the last week, then you see both of them fall. And in that kind of scenario, treasuries are not a good hedge for equity. But if we did see the sell-off continue, and we did see people capitulate, and we saw 20-30% fall in equity markets, I expect then we'd see treasuries would rally. That's the weird logic of these things, because when people are scared, very reliably they buy treasuries. Now, there's also another situation which we've also got at the moment where treasuries don't hedge equity, and that's in the case of a US Treasury default. Now, this is unthinkable. It's unthinkable, and it would be catastrophic, and there'd really be nowhere to hide, I don't think, except maybe cash and gold if this happens. But the idea is that the US might default on its debt if they don't raise the debt ceiling soon enough. And Janet Yellen says it might be as soon as mid-October when the US runs out of money to pay its bonds. Now, if that happens, then all bets are off, right? Because suddenly the asset that was the safest asset in the world, US Treasuries, isn't safe. So those prices would fall, the treasuries would fall, equities would certainly fall a lot. Moody's thinks by about 30%. I suspect it might be more. And if that happens, then clearly, treasuries would be a very poor hedge. So let's just hope that doesn't happen, and they solve this issue with the debt ceiling. But in both those situations, taper tantrum, US Treasury, threat of default, I don't think it's going to happen. In either of those cases, then treasuries wouldn't be a good hedge for equity. But anyway, I did a whole video about that for members this week, which Patreon members get access to. And anyone who signs up for Patreon gets access to that. And if you do want to do that, there'll be a link in the description of the video to sign up for Patreon. In fact, all of the things I'll discuss, there'll be links to it, including SharePad, which I also showed you. We have an affiliate link there too. Right, next question. Martin H. Is that Martin Handbach? I suspect it is. Hi Ramin, great videos and live Q&A. Keep up the good work. Thank you, Martin. How should I invest my cash positions to counter inflation in the short term, 1 to 2 years? Can you give specific examples in euros? Oh, interesting. Well, I think the best inflation hedge is usually inflation-linked bond funds because explicitly the bonds that they buy are linked to inflation in a particular region. So if you buy a European inflation-linked bond fund, that will be linked to the rate of hiccup inflation, HICP inflation in Europe, probably. And if inflation increases, if the cost of living increases, then it'll ratchet up the coupons and the principal of the bonds, and the fund's value will increase as a result. So that's probably the best inflation hedge there is. Cash also is a fairly good inflation hedge if inflation's not too high. That might sound a little bit weird given that inflation is the erosion in value of cash. But just remember that most of the time in developed markets, inflation isn't usually very high for very long, or at least it hasn't been for the last 20 years. If we do get high inflation, that's above 5%, say, for a long period of time, then clearly cash would be a lousy inflation hedge. But even if it was, say, 2% inflation in the Eurozone, just bear in mind that a one-day move in equity markets is a 2% move, 1.2%, 2%, something like that. So if a one-day move in equity markets is equivalent to a one-year loss in the value of, in the buying power of cash, 1 year's loss compared to 1 day loss, it doesn't seem so bad when you put it in that context. So if you're willing to buy equity risk, then cash risk, which is the loss in value due to inflation, is negligible. And I also say this to people who've inherited a large amount of money or sold a business, or, there's no huge pressure on you to invest it. You can take your time investing that money, because inflation, even though there are lots of scare headlines about inflation at the moment, and people who are gold bugs always say that inflation's about to make money worthless. Ray Dalio says cash is trash. Bitcoiners, they say cash is trash. But the fact is that it is very stable in value. So I really wouldn't worry too much about cash being eroded by inflation unless it gets, say, above 5% inflation. And then the other point is that if you've got long duration bonds, they're the most heavily affected by inflation. So if you do think inflation is going to be high, just keep away from any kind of bonds, because any kind of duration, and the longer the duration, the bigger the loss due to higher inflation. So those are the kind of things you could invest in. Gold is a terrible inflation hedge. I'd keep away from that. But if another inflation hedge would be equity, as long as inflation isn't too high. Again, if inflation goes above about 5%, equity markets tend to sell off, because that starts to be an economic problem for the companies as well. Or if you get deflation, similarly, equity is a very poor deflation hedge. But I mean, if you're trying to keep the money constant in value, Martin, then cash is a pretty good choice. So if you've got a big purchase coming up of a house or something, then that might be one way to keep it safe. Cash is a pretty good way of doing it. Or inflation-linked funds, if you are going to be holding it for, and you do think inflation is going to be very high, then inflation-linked bond funds would be better than cash. So I hope that helped. John MSP says, impact of Basel III on price of gold and gold miners. I think the actual effect of Basel III on gold prices, I wouldn't have thought there'd be a massive effect on the price of gold from Basel III. I mean, that's more to do with financial regulation and what banks can hold in terms of regulatory capital. And I don't think there's going to be a massive change in how gold is treated on the balance sheet of banks. So I don't think there'll be a massive impact of Basel III on gold prices, or on gold miners for that matter. So, I just don't think there'll be much of an effect. Hisham, But if I've missed your point there, John MSP, just tell me and just make a comment, and I'll kind of come back. But my initial thoughts would be that there'd be a negligible effect. Hisham. Hello, Hisham. How are you doing? So Hisham Daoudi often makes a comment. Nice to hear from you. And he's also one of our supporters. Yep. So he says, I'm wondering about what to look at to choose the domicile country of a global bond fund. I'm from Belgium and my fund is based in Luxembourg, but I'm wondering if Ireland is not better. Okay. Right. So it would depend on the tax treaty between the domicile of the fund, i.e. either Luxembourg or Ireland, and where the assets are held for the funds, for the assets. So I suspect, so for example, if it's got a lot of US bonds in it, then the primary interest from your point of view will be the tax treaty between the domicile of the fund and the US. And it is the case that most global bond funds will be 40% US bonds, because the US bond market is bigger than everyone else's by a long shot. So that's what you've got to find out. Now, good luck finding it, because I find it very difficult to look up that kind of thing for a global fund, because the reporting is usually very poor on the kind of tax implications of holding a particular fund. So I know of no good way to do that. So really all you can do, look to see where the assets are, the country breakdown of the assets of the fund, and I think you will find the US dominates, and then you'd have to look up what the tax treaty is between the domicile of the fund and each of those countries, and then you'll have a weighted average. So 40% is US and the tax rate is 15% withholding tax, then you'd create that weighted average withholding tax for the fund. It's not going to be easy, but to first order, look at the US. That's probably the best way to do it. Yeah, I'm sorry I can't help you with that, but that's the way I'd treat it if I had the data. Oh, another question from John MSP. See Andrew Maguire comics unallocated gold. Ooh. Okay. I wonder if you mean now. I'll try Googling that very quickly just to see what that is. And yeah. Oh, okay. So this is a video. Okay, so he has got some videos about Basel III and LBMA stalling antics won't stop the gold. So it sounds like he's a gold bug, and he's talking about, I guess, banks having reserves stored in the form of precious metals. Because gold bugs, they love the idea of central banks or maybe even retail banks buying gold and silver. But yeah. Personally, I'm not convinced there'd be a massive effect, but I could be proven wrong. Right, so back to the questions. So do like our stream, and also don't forget you can subscribe to our channel. And if you do a super chat, you'll be pushed to the front of the queue to have your question answered. And so let's have a look at the next question. So A. James says, imagine inflation is also higher and longer than expected, aka transitory, but for a long time. Yes. So transitory, we don't know how long it is. It's just temporary. But as you say, it could be a long time. Would platinum do well in that scenario or not so well? Well, remember that the inflation linkage between precious metals and inflation is very weak. If you look historically and you look at the returns on gold and you plot that versus inflation, there's a very weak linkage between the two. So I think it's a false narrative that gold is a good inflation hedge. Gold is a good hedge when interest rates are low because it's a wasting asset. So it does well when real rates are low. But is it a good inflation hedge? No, it really isn't. The reason why people, I suspect, think it is a good inflation hedge is because during periods of hyperinflation, when money effectively becomes worthless, then gold becomes a useful way of paying for things, because that's people still want the shiny stuff. But during a normal period, and by normal I mean inflation less than 50%, then I think the kind of value of gold as an inflation hedge is just almost non-existent. And I've got a video that I'm probably going to do soon, which will trigger all of your gold bug friends. So if there are any gold bugs watching this, prepare to be triggered. So yeah, I think it's a very poor inflation hedge. And platinum similarly. You know, platinum is much more of an industrial metal, so that's much more of a cyclical metal because it can be used in things like catalytic converters, in combustion engines. And so there I would expect that it would have a slightly negative impact if inflation is high. So I wouldn't have thought platinum would do particularly well if inflation is very high, unless it's commodity driven inflation. So if platinum's part of the problem, then yeah, you'd expect it to do well. But what we're actually seeing at the moment is that the things which have really gone up in value are things like gas, petroleum, gasoline, natural gas, and we haven't seen a real spike for things like precious metals. Some industrial metals, for example, iron, has collapsed in value. That's fallen by 50%. Copper's pretty much held its value fairly well. But yeah, I think each of the metals is treated slightly differently by markets and by the macroeconomic environment. But expecting precious metals to be an inflation hedge is just deluded. It's not going to work. Just look at just plot it. Just plot the return of platinum, gold versus interest rates historically, and you'll see what I mean. And I've done that in the past in videos on gold. Rushar, hello, nice to hear from you. You say, hi Ramin, which factors are causing the increasing in 10-year yield? Is it likely it will continue? Yeah, I think it is likely it'll continue. What the primary reason I think is because the Federal Reserve said that it's going to raise interest. It's not going to raise. The Federal Reserve said it's going to taper its asset purchases in November at the next meeting of the Federal Reserve's Federal Open Market Committee, the FOMC. They've pretty much said that they're going to do that. And that's what made people think, oh, taper, tighter policy, higher interest rates. Even though the criterion for raising interest rates is much higher, much more difficult. So in order to taper, you just need substantial progress towards the Fed's goals of inflation at 2% and full employment. Whereas to actually get liftoff, which is when they raise interest rates, they have to be close to full employment. And we're still a long way from full employment in the US. And that's been one of the things which Powell has stressed through his entire chairmanship of the Fed. He stresses full employment is very important because that's part of their mandate, right? That's half of their mandate. So I think it's unlikely that that's going to be. It's unlikely we're going to get very, very rapid increases in interest rates anytime soon, because there'll be a long period between when tapering starts and the asset purchases slow down and when interest rates increase, unless inflation really gets out of control and stays high. But at the moment, there's very little evidence to show that that's going to happen. Okay, question from Marco Meyer, who says, do you know the book Rule Number 1 Investing by Phil Town? And if you do, what's your opinion about it? I don't know that book, actually. Is it good? Is it good? Maybe it's one I should look at. I'll certainly look at one of the blinks because one one of the apps I use a lot is Blinkist, and I actually did a promotion for them because I like it so much. But yeah, I'll have a look to see if there's a Blink first of all, and if I like it, I'll get the book. Thanks, Marco. Next question. Also, hedge funds based in London. Interesting. Okay. Oh, my goodness, there are lots of questions. Okay, let me scroll down a bit. Success from Chess says, I've been wondering about that book too. Okay, so maybe it is worth a look. And Louise says, hi from Essex. Hi, Louise. Ned Flanders, brilliant. Hey mate, love the channel. Do you see bonds coming back as a good investment? Feels weird investing in them now as they have such a rubbish return. Yeah, I mean, I hold them because they hedge equity. But if you know, I will be moving to 80% equity in my portfolio. So first of all, I'm selling the cash. So I'm using the cash to buy equity. And when that runs out, I'm going to start selling my bonds to buy equity. Ali Armadi from Kent Southeast. Nice to meet you, Ali. HM the King. Ramin has diamond hands. Yes. When it comes to bonds, I do. Danny Fairley says, I have an MChem in chemistry and I work in big pharma, pharmaceuticals and regulatory affairs for 3 years. I hate my job. I'm sorry to hear that. What's my chances of getting a job in investing? Well, Danny, I mean, if you're numerate, that certainly helps. If you're a recent graduate, again, you know, that helps. Then the way to do it is to, it certainly helps if you've got something like a qualification like so some kind of qualification in investing would be useful. And so a lot of people go for the, what's it called? Yeah, I've forgotten what it's called, but there is a standard qualification. I think it's called CF. Oh my goodness, I've forgotten. But anyway, yes. So it's a chartered thing. Let me just look it up very quickly. It's not CSP. Yeah, I've completely forgotten. How bizarre. But so you can go for a qualification which would effectively tell people that you know the basics about the investment industry, and that's probably the best way to go. So if you do want to do that, then having some experience in investing certainly helps. But usually the way the investment banks work is they go for the best universities because they can. They just hire loads of graduates from those universities. They're brutal with the kind of filtering criteria. So they only take the best students and then they make them sit a test. And if there's any kind of problem with the test, they don't accept them. And then once they pass those tests, they bring them into the office and they have some time on the desk. And if they're okay, then you know they get to keep them. And initially, it's quite menial work. They usually do. You get a lot of bacon sandwiches, a lot of coffees for the senior staff. So that's the way banks kind of hire people. It is very, very brutal. Just be aware of that. So it will be tough to get a job. The best way to do it is probably via a friend. If you have a friend in the industry, that probably will help a lot. And another way to do it is via other departments at the bank. So the way I got into the front office of the investment bank was via tech. So for some reason they hired me because I had a physics doctorate. They thought, okay, this guy can do numbers, so he can work on a risk system. So for about 3 years I was working on risk systems as a developer, which I found completely boring. But essentially that meant I was in the bank. And then once I was in the bank, I could move to a department that was more quantitative, and then I moved into the front office to do research, and then I was meeting clients. Because the closer you are to the money, the clients, the greater your salary will be. So once your foot's in the door in one of those departments, and another big department in an investment bank would be an operations, ops they call it, where effectively you'll just be reconciling trades just to make sure they've been booked properly, and all of the other bookkeeping which has to be done to make a bank's plumbing work. But then once you're there, if you're good enough, you could probably move within the bank. So just think of that as another way in. So those are the best ways to do it, I think. But there are very varied roles in a bank as well. So I've written a book called A Financial Bestiary, where I actually went through the individual roles at a bank, because it was like animals at the zoo, right? You've got your trader, you've got your debt origination desk, you've got your operations, you've got your trader, your prop traders. You know, each of these individual roles are very different, but banks require all of this in order to work as a modern investment bank. So just don't think that there's only one role. It's a whole world of roles within an investment bank, and a lot of them are really interesting. You know, things like Treasury, which you might think, well, that's not interesting. But I actually taught some of the Treasury people when I was in an investment bank, and it was really interesting what they did, just making sure the bank has enough money to just pay its bills day to day, and that it doesn't breach certain capital requirements. You know, really difficult technical work, but probably very well paid. So, you know, there are many different roles that you could do. But look, if you want to help with that, I do power hours, so you can have one-to-one coaching with me. I actually helped one guy get a job as a strategist, so, you know, I'd be happy to coach you if that's the road you want to go down, if I can help. Okay, Stephen. Oh no, we did that one. Oh, time. Laura says it's 8 o'clock. I was having so much fun. I forgot the time. Sorry about that. Okay, so it's 8 o'clock. That's time. And thank you all for joining us. I hope it was useful, the session tonight. And we'll be back in 2 weeks. Remember, you can still like this, and you can subscribe to our channel. And that way you won't miss all the good stuff which we produce. And thank you all for your brilliant questions. I really enjoyed it. And I hope you enjoyed it too. So take care, everyone. I hope your portfolios do well and you see through this period of volatility with your portfolio. Take care, everyone. Bye-bye.